We're back. I accidentally completely messed up, and I quit the stream instead of just stopping screen share. So that's one way to do it. But the TLDR here, I'm just going to share out this this again, just so we got it. Updated link. All right. So the TLDR is that, by the end of this year, I think that it's somewhat clear for the rest of the FOMC governors where they kind of believe that they're going, right, which is like 2 rate cuts. However, in Jay Powell's comments, he was way more hawkish, in my opinion, than he was in that Jackson Hole speech. And we talked about the Jackson Hole speech, and the whole big thing that he was saying is that inflation was less important to them, and their biggest concern was the economy, and in particular the unemployment rate going up through this like jobs data. He confirmed again that like jobs data was their bigger concern. No, he confirmed that jobs data was more concerning to them than where it was in June. And when he was kind of asked about this, instead of him saying like that is their number one thing, he said, oh, we were actually way more shifted towards inflation, and now jobs data has kind of shifted us the other way. So we're kind of in the neutral zone, in the middle of the two. And I think like there was a lot more of a sense of a worry about inflation coming in this one. So they're kind of going meeting to meeting, which makes it way less predictable. And that's where we saw a relatively negative reaction last night, at least. But no, go ahead, Austin.
Well, I remember you mentioning, it was either last week or the week prior, that you had a feeling that a cut could actually be a hawkish signal, and you sort of floated this idea of a hawkish cut. And I think that is actually what's playing out here.
100%.
25 bips was like pretty much what markets expected. And I think that markets are cheering the fact that a cut did happen, but the risk that we're looking at here is that they might be front running the Fed, thinking, okay, additional cuts are going to happen. Inflation is basically dead, but inflation isn't dead. And, there is always the risk that rate cuts this early could actually fuel asset bubbles. As you mentioned, Powell sounded more hawkish in this last meeting than he did at Jackson Hole. And I think that what he's trying to do here is remind markets that inflation risk does still matter. You're talking about this sort of balance between inflation and employment shifting towards jobs. That's kind of new. That's interesting. And I think that even so, if goods inflation does prove to be sticky, cuts now could backfire. So it seems like that's something that he's trying to almost signal against. The bottom line here is that we may be in a market environment that wants to believe in easing, but the Fed may not have as much room to deliver as traders actually think. And they could potentially be boxing themselves into a bit of a corner there.
I would completely agree with that. And I think, the comments that Powell said around inflation, he reaffirmed that 2% inflation is still their target. However, when you look at the dot plot of when they think they're going to get to that, it's 2 years, and it's been 2 years for like the past 5 years. It's just this like continuous moving target of 2 years. And I think the reality is the way they're operating is that they are operating much more towards getting to like a 3% being the new 2%, even though they're not saying it. And I think that's pretty indicative of the sentiment around like and what the dot plot shows in some of this. Now, despite all this, and you talk about the worries of inflation, things like that, markets have shrugged this off today. And I had a feeling this might happen when I saw the red charts yesterday, because there is just this huge resilience in the market and risk appetite, which we've talked about before, both on the equity side and also on the crypto side. And we've seen a really nice steady grind up in the majors, both BTC, ETH, Sol has had like a nice day as well. They're all grinding upwards past some of their like weekly opens as well, which is good to see. The inflation side of things, the worry we would have is that pretty much all of it is isolated to like goods inflation. Um, but I think it's going to be one of those things that if we see a few positive reads on inflation data over the next few months, it will buoy the market and I think like get more momentum coming into it. I think ultimately we were all hoping for maybe a nice surprise where things were a lot more dovish than I don't think many people thought we were actually going to get 50 bips, but hopefully the commentary was a bit more dovish. So I think like that's what we want to kind of like be focused on over the coming, especially next month or so, is just seeing how the market responds to more economic data coming out. But I think crypto is positioned nicely here. A rate cut is good news, and usually you see the impact of that, even if it is just 25 bips. The rate cutting cycle is going to continue through the year. You usually see that a couple of months after.
Well, let's see what happens in the next couple of meetings here. If that dot chart is any indication, this isn't the last of the cuts that we're going to see, and the political pressure is going to continue to be downward.
Yes.
So,
yes. For sure.
Yeah. Well, speaking of rates and markets, the SEC is doing some really interesting stuff right now. They're easing spot ETF rules, which we've been covering for quite some time on this podcast. These new crypto ETFs, like the Bitcoin ETFs and the ETH ETFs, that have had such a large impact on crypto markets by getting institutional and consumer investors bought into crypto. And the SEC is making the process of launching a spot ETF a lot easier. If you recall, back when the Bitcoin ETF was going through its approvals process, that was quite excruciating. The ETH ETF,
understatement.
yeah. I mean, that was like so much speculation. People were thinking it's never really going to happen. This is going to be the thing that we talk about ad infinitum, and it like never really occurs. And when it did go through, that was huge news. I mean, we dedicated a couple episodes to basically just watching that process and the effect that it had on not just Bitcoin, but on crypto as a whole. That's how big of news that was. And then the ETH ETF was, a muted but similar version of that. I mean, it was still quite a big deal. But now the SEC has approved new rules letting exchanges like the New York Stock Exchange, the NASDAQ, list spot commodity ETFs, which includes crypto, under generic listing standards. So what does that mean? Well, in practice, it means that it will cut the approval time from an average of 240 days to as little as 75 days. So that excruciating process that we went through with the Bitcoin ETF, and then a muted version of that with the ETH ETF, will have been cut down dramatically and simplified dramatically.
Don't forget the Dogecoin ETF, which went live last week. I haven't even looked at the flows on that. Yeah, I have to check in on that one.
So before, each ETF required a separate SEC approval process, and that's why it took so long. But now, under these generic listing standards, if an ETF meets the standard, exchanges can list it automatically. And that's what brings it down closer to 75 days. There are some key criteria that are involved in this, like the fact that the underlying asset must trade on a surveilled or regulated market, or have CFTC regulated futures with at least 6 months of history. So there are some requirements that have to be met, or an ETF can qualify if another already listed ETF holds less than or equal to 40% of that asset. So,
okay.
or sorry, greater than or equal to.
Yeah.
Greater than or equal to 40% of that asset.
Okay. Yeah.
So basically what they're saying here is if there is an existing ETF that holds almost the majority of that
Yeah.
asset and it's listed already, then you can qualify.
Interesting.
So effectively what this does is it removes a major bottleneck that slowed these ETF launches. It should speed it up a lot.
Yeah, this is good news. I think in general, for when we had, especially post ETH ETF, and we've seen the flows. You mentioned they were kind of muted at the start, right? But the flows since then have been huge. Same with the BTC ETF, of course. But I think we were expecting just this flood of new asset ETFs like coming through, and it has been quite slow. Solana being like one of Node, XRP, other ones like that. So I think, yeah, this will just we'll see more and more of this come in. We'll see more institutional access. And there is, of course, an enormous appetite, especially in the US now, for institutional access to crypto for sure.
Yeah. So I think that a way to, think about this is that with faster listings also comes faster product rollout. So institutional managers who want exposure can now, get it through regulated ETFs in weeks instead of months. So this is going to speed up that cycle a lot, and it could open the door for some more atypical or exotic crypto ETF structures, not just Bitcoin and ETH or even Dogecoin, but I think that it shows that regulators are moving toward normalizing crypto within existing financial plumbing rather than treating it as a sort of one-off exception that they're
Right.
making for each ETF. And as a result of that, you're going to see some more adventurous ETF structures come through.
I'm genuinely interested to see. I best look this up. The Dogecoin ETF flows, because I'm curious to see like what we think, what the kind of appetite is for the more, I guess you would call Doge like more exotic.
Yeah.
Do we have it? Is it actually live yet? I think it's not technically live yet. I think it's been approved, but it's not actually up and live. We'll have to check in on that. But yeah, I think that's going to be really, really interesting. And I think if that performs well, you'll see a flurry of alts joining the ranks. I imagine Hype would probably be one that would get up there, and a few others. So yeah, there'll be a lot of speculation and a lot of price action around speculation, no doubt, for those like less liquid assets.
Yeah, I mean,
happens.
it definitely feels like a capital infusion hack.
Yeah.
If you go far enough down the list of altcoins. But what is interesting about this, I think, is that if you combine this with the Fed cuts that we were just talking about a moment ago, you've got a recipe for much faster institutional adoption of crypto than I think people expect right now.
Yeah, and I think combine that with the digital asset treasuries as well. And it's like all of these three things like pulling together, macro lining up, ETF, institutional exposure, digital asset treasury, equity exposure, both for maybe institutions but also for retail, to get some slightly different exposure to the long tail of assets as well as ETH and BTC and Sol. Yeah, it's all kind of like pulling together, isn't it?
Yeah. That said, loosening the guardrails on these things also means that there is sort of inherently going to be a higher risk of fraud and misuse, especially if ETFs are approved on, thinly traded or exotic tokens, since now we're operating under this, general listing standard, set of general listing standards. So I think this this sort of like default assumption of, oh, if it's crypto but it's an ETF, it's like really safe, maybe is not quite as strong going forward. And there's on the individual level and even at the institutional level, there's going to be some additional scrutiny required. And really, that's important, because this is one of those boring sort of market plumbing changes that I think a lot of people gloss over, but the downstream impacts of this could be pretty huge. So ETFs are on the move. And that means that's going to mean a lot for the market. I mean, I think that in general, we've had some good bullish sentiment in the market as of late, despite this sort of, weird hawkish cut that we just saw from the Fed. But I was looking at this Bank of America survey that just recently came out that was showing some overvalued signals that I thought would be interesting for us to talk about in light of the Fed cut and the SEC easing its spot ETF rules. Where does this play into the market more broadly speaking, and what is the health of the market more broadly speaking? And this Bank of America survey found that 58% of global fund managers say that equities are currently overvalued, and that's actually the highest number that they've ever recorded on that survey.
Yet all of them are long equities. And this is the funny thing, right? Is like, I don't want to be like hyperbolic here and dig too much into bubbles, but literally, like, what was the famous quote? Like, no one gets paid for being bearish or something. And it's like, I think like the idea of like during bubbles, even like bubbles can last quite long, but also it's hard for allocators and fund managers to not be going long in these market conditions. I mean, I actually, let's just have a look quickly at where the Nasdaq is right now. Market opened an hour ago. Nasdaq 100 is 1.15% up. S&P is 0.65% up. Huge green day on equities, despite what we've talked about. Crypto continues to grind higher. We've got ETH just pushing above 4,600. BTC now challenging
118.
Yeah, 118, like coming close to that. and I think this is like a big piece. Is like this FOMO that is coming in, right?
You're totally right. I mean, you look at this, 58% of global fund managers say equities are overvalued. And like I said, that's the highest ever. But at the same time, stock exposure is still climbing. And that's classic FOMO behavior. I mean, look, to go back to sort of your adage there that, nobody ever gets rich by being a bear. Yeah, I think that that's generally true. But then you also have like these weird outliers like Michael Burry, who basically, see this FOMO happening and short the entire market. Or in that case, I guess it was the housing market.
For sure. I think it's like, so I think in the midst of a bubble, it's so much easier to win going long, right? Than it is to, to basically predict the big short. It's very hard. And I think when you look at risk appetite, like I bring this up again, we talked about this a few weeks back. This is credit spreads. This is the premium for which investors are demanding for corporate bonds versus government bonds. When this number goes down, it means that investor risk appetite is very high, because they believe that, like, basically buying corporate bonds is not very risky, and they only require 2.79% of a premium on just like getting government bonds, right? Look at this giant spike. This was April,
Yeah.
right, when we had that crash, all the way up to 4.61%. Huge steady grind. Now, this is a tiny spread, right? That like we start going back. Look, this
Man,
is where we're at.
historically, oh my gosh.
It's a huge amount. This is by the way, look at where I am right now. It's 2021. That's summer of 2021. We are below it right now. This is like
Unreal.
That's the pandemic spike. Like we can keep going back. Credit spreads
we are at
at
low lows right
historic lows, right? So like this for me is the chart when you want to be looking at investor risk appetite and you want to second guess yourself. This is why we're talking about today equities, complete rebound, and crypto having a complete rebound after a red day, after what is, in the context of what we wanted, like bad news, right, from the Fed. Right? We're hoping for like really good news because everyone's like super bullish. And this was like, it's a bump in the road. It's nothing major. We got a rate cut. That's great. But people were wanting much more. But time and time again, through any of these moments, the markets are showing, the US equity markets, crypto markets are showing a lot of like anti-fragility. They're just absorbing any negative news, and they are buying the dip and rallying past it. That for me is like huge amount of strength, and why I believe we've got still the biggest kind of rallies yet to come in the market. And it's very hard to know. I mean, first of all, it's very hard to know when you're in a bubble or not. I think you look at valuations and whether things are overvalued on the equity side to get a good sense of that. And when you look at like where rates are today and you kind of normalize for that, valuations don't look as bad as they do, like when you're not taking that into account. But I think there's definite froth. There's definite froth. I mean, I don't know if you saw Intel today. Intel up like 30% today on a deal with Nvidia. It's just like 30% in a day for a market cap the size of Intel is wild. And we had Oracle the other day, similar.
Oh, yeah. And what do all of these companies have in common? It's that their growth is being driven by AI and semiconductor optimism. And this is the same thing that we're not just seeing this in US markets, we're seeing it in Asian markets as well, like Japan, South Korea, Taiwan. They're all hitting record highs. And it's fundamentally driven by AI and semiconductor optimism. And I think that there is a bull case to be made here for sure. This is a question of, like, can I believe what's in front of my eyes? And I think that this goes hand in hand with the Fed decision too. When valuations are stretched this far, you take really small shifts in Fed policy or inflation outlook, and you can get really big corrections as a result of it. And definitely with, AI leading the charge, that means that AI is probably going to be where cracks would show first if liquidity starts to tighten. So I think that would be the area to be paying the closest attention to. Crypto is a little different, but it's still a pretty high beta risk asset. And as we've seen in the past, and I don't think that this is any different, despite the fact that we always want it to be the case, it would probably follow equities down in a sharp correction as well.
100%. Do you know the thing that though, like, we talked a lot about like inflation. I always look forward. I'm like, okay, why should I be bullish or why should I be bearish? Right now, I'm very bullish. And the reason why I'm very bullish is because what I see as the biggest risk, right, is Fed policy up to now has been restrictive. And, Jay Powell's come out and said that. And we, despite this, investor like risk tolerance and appetite has powered through. And, that's why we're seeing in equities, at least, all-time highs. I mean, in crypto, we've had all-time highs through this year across most major
Yep.
assets, even including ETH. And, so then I look,
I know.
I'm like, okay, what's the biggest risk? It's that tightens up a bit and the Fed get much more restrictive. And the reason why that might happen is if inflation picks up.
Yes.
And that's the biggest risk. The reason why I'm very bullish is what I think is actually pretty clear right now. Despite everything that we've been kind of talking through in the dot plot, etc., I think the dot plot says one thing quite clearly. The Fed is willing to run it hot and cut into rising inflation. Like that is the case. And is that good in the long term? Yeah. I mean that's what they're saying. That's what they're saying with the dot plot, right?
If you like you said, you literally pointed that out earlier in the show. The inflation expectation did not change, but the rate cut expectation changed. And
with economic growth improving in their dot plot. 2 years until we get to 2%, not happening. Full stop. Like I'm calling bullshit on it. But like they're
it's
willing
2 weeks to
cut
flatten the
through it.
curve, Matt. You just need to flatten the inflation curve.
So this is it. So for me, it's like long term, I don't feel good. Actually, do you know what? I'm talking about long term in the sense of like the next 18, 24 months. That's not really long term at all. But I think that's the place that we're at right now. We're living week to week. Short term, I'm extremely bullish. I don't think anything stops this train through the end of the year. Q1 probably as well. Then I think we really got to understand like where things start playing out and how the economy's looking, how resilient it is, and if we start seeing any cracks. But for me, looking at all of these things together, certainly from a crypto perspective, very, very bullish setup. And I think it's hard to deny that.
I love it. All right. Well, I think we're going to have a really interesting ride ahead of us over the course of the next, well, definitely through the end of the year. That'll be very indicative for 2026. But looks like 2026 itself is just, I mean, they're all over the map. So
I don't think anyone knows what's going to happen in 2026. I don't have a clue. I feel like, I've got a good thesis on 2025, but, lots of things can change. 2026 feels like 10 years away.
It does. But by the way, man, to your credit, even going into the U.S. election last year, and right after the election toward the end of 2024, you were very bullish on 2025 as being like this golden era to make money in crypto and equities. And I think that has largely proven true. I mean, we've seen incredible highs.
Yeah, and my thesis, and actually, I remember when we were talking about that at the end of last year, my thesis back then was exactly what I'm saying now. But it was a little bit more geared towards fiscal policy versus monetary policy, and that I was like, the Trump administration will do everything in their power to have a bullish year on the equity front. And that has absolutely been the case. Look at like how involved they've been in monetary policy in the Fed. And the Fed now is kind of on board and they're willing to turn a blind eye. I'm not saying that they are on board with the government. I think they are on board with a path towards cutting rates, which is complementary, and they are willing to overlook inflation risk. So yeah,
I mean, aren't they going to have to just keep throwing freaking gasoline on the fire in 2026 because it's a midterm year? So I'm like,
another reason to be bullish.
Yeah,
and Jay Powell leaves in May. Don't forget that.
Yeah, that too.
And who have we got coming in? We got Myron in there, who's very aggressive.
Put him in charge.
Rate cutting agenda, right? So like, he's a front runner for next Fed chair. It like there's going to be a lot of change in the Fed. And I kind of think actually one of the bigger risks on the Fed is less actually their ability to deal with inflation and more that the market loses trust in the Fed and the whole independence piece. That is what can actually really swing bond markets. And when you start to see that happen, has a real knock-on effect into equities and crypto as well. But
I think it's an excellent point. I mean, the Fed has struggled to rebuild its reputation post-COVID.
Definitely. Agreed.
And personally, the more that I feel that the federal government and Fed policy, or you could say politics and Fed policy, are intertwined, the less I'm trusting the Fed. They're supposed to be separate from each other. And that's regardless of whether you even agree with the outcome that's being created.
Yes.
You know?
Yeah, like fiscal and monetary policy were designed to, in the US, as they are in the UK, to be a church and state situation. And that's not the case. I mean, whether Trump is or is not having an impact, I mean, he almost certainly is, but like the degree to which he's having an impact, the fact that he's been able to do what he's been able to do should be at least a concern for people, right? Like that care about Fed independence. I think even if you disagree with the Fed policy, I think there's like, you can criticize Powell and the FOMC, but I don't think it's the right thing to be pro breaking down the independence of the central bank.
Agree.
But you know, this is going to be definitely one of those things that we look at the end of next year, and I think there'll be a lot of things that are just like, man, it was so obvious. Kind of like when we went into the rate hiking cycle too late, and we were talking about transitory inflation, and you know, looking back, it's like so obvious. And so zooming back kind of out a little bit here, obviously the next few months are going to be key. Personally, still feel very bullish about Q4. I'm really interested to see how the next week plays out. I think we're going to start to see well, we're already seeing a big rebound in equities. I do think that crypto is going to catch a bid through next week, and I think we'll start to see some runners happening. So I think hopefully we'll get some interesting, exciting price action we can talk a little bit about as well. But until then, we will we'll leave it there. And Austin, I will, as always, see you next week for another episode.
Talk to you then, Matt.